turns out to be a multi-bagger for the patient investor, the real long-term investor. So congratulations on that.
So thank you so much, Ajay, for having me on the show. And in a way, you have actually relayed my feelings on the same. That at the end of the day, this 3,000 rupees NAV is nothing else, but it's a reflection of about 22.5% CAGR returns, which investors have made in this fund over a period of 28 years or so. And it's also a reflection on this long journey that in this journey of 28 years, there were multiple instances when we saw drawdown exceeding 10%, 20%, even 30% plus at times. But those who remained invested, who remained part of this journey, are the ones who have reaped the benefits of this healthy compounding which fund has delivered.
In fact, I must tell our viewers that in this 28-year period, such a lot of massive volatility, COVID, wars, global issues, but still if you held on, you have doubled your money every 4.5 years at 22.5 or thereabout, close to that. But we'll move and talk about markets, the factors at play. Rupesh, today's commentary from Governor, two points from the market standpoint. One, upping of growth estimates on the full year basis to 7% going forward, especially in light of this bumper surprise of 7.6% of quarterly GDP, and also seeing the inflation trajectory turning out and going to 4.2% by Q3 of next year. What does it mean from the market standpoint, these 2 points?
I think no doubt the general consensus in the market is that we have seen probably peak of interest rates, though they may not come down in a hurry, but I think we are more or less towards the end of interest rate hikes, unless some global events happen and that may change the view. But globally also, the view is that as far as the increase in interest rate is concerned, we are probably towards the end of the cycle, but there also the view is that interest rates may not come down in a hurry. So I think going ahead, the expectation is, again, which is a consensus view, that because of this higher interest rates, there is expectation on global growth slowdown, and that can have some impact on our own growth as well. So that's something which we have to watch out for, but nonetheless, the growth expectations being moved up by central bank is something which augurs well for market expectations, and they're getting built into the earnings growth estimates as well for the companies.
Rupesh, I was looking at your sectoral leanings, and I saw that finance, bank, pharma, industrial, and retailing. Which, to your mind, is the most undervalued part of the market relative to the growth it offers? Because it's a market which has run up, be it the large cap universe or the small or mid. But where do you see highest relative value? Any sector or theme?
I think honestly, I mean, today when we look at markets, we believe that rather than looking at them on a sectoral basis, it makes much more sense to look at companies on bottom-up basis, and there are opportunities across the board. But still, if I have to, look at my own fund and try to answer your question, you will see that we have significant exposure to financials. And within that, we are very well diversified across lenders, whether it is a bank or an NBFC, or we are also we also have exposure to businesses which kind of benefit from trends on financialization of savings. So whether it is online broking firm, or whether it is exposure to distributors of financial services products, or a general insurance company, or a life insurance company. So in that sense, the exposure to financials is a significant overweight exposure in our portfolio. But within this, we are very well diversified across multiple business models, which will benefit from longer term trends around financialization of savings and trends in increasing penetration of credit going ahead.
In particular, the small finance bank and NBFC, which are SMA oriented or the small borrower oriented. But this borrowing is more about productive borrowing, not the unsecured consumer discretion. We've seen that this is the part which is providing very high growth in terms of loan disbursement, and asset quality is also under check so far. Do you see
Yeah.
this as a structural theme?
So if you look at our exposures, then I mean we are also more concentrating I would say, I mean, not too much focused on lower end of the spectrum or lower ticket size lenders. We have, I mean, if you look at the construct of our portfolio, it's a very good balance between small finance banks as well as some of the B2B lenders. I mean, some sector specific lenders, which is very well evident in the portfolio. So more focused. I mean, not too much focused on the lower end of the spectrum. That's what our positioning is also in the portfolio.
Sure. Let's talk about some of the overseas plays, kind of export, or I would say plays in the market which are more of the external environment centric, like pharma, IT. What are your thoughts there? Do they provide good value?
So our view on some of these exporters is not so constructive as yet. So, for example, if we talk about IT, then we have underweight stance in our portfolio. We believe that the growth expectations, I mean, to some extent, it has got revised downwards. But in an environment where global growth is uncertain, there can be more headwinds in terms of growth for some of these companies, because the nature of spend may shift from a shift away from discretionary, in fact, which we are already seeing. There is delay in concluding large deals, and all these can have growth implications for IT companies. Though in last 1 year or so, we have seen correction in valuation multiples, but still we believe that that is one segment where we would still be cautious. Chemical is another space which has, I think, one of the biggest risk, which is again a very well-known risk, is around the outcome of elections. So if there is continuity in terms of current government, which means market would extrapolate continuity in policy, and which would be taken very positive by the market. But any disappointments over there can be a risk to the market. But that's something which is very well known. Apart from that, I think globally we are in a very uncertain geopolitical environment. So any big geopolitical events which can trigger risk of environment in global markets will have impact on India also. We cannot remain isolated. So I think those are some of the risks which are there on the horizon and which we have to be mindful of.
Right. All right, Rupesh, we'll let you go in that one. Thanks so much for joining us on the show.